Welcome to episode 29 of Bullish. Thanks so much for joining us. We've got Ron Bousso with us today. He's an energy columnist over at Reuters. Ron, so excited to have you on Bullish. How are you doing today?
Very good, thank you. Very excited to be here too. Thanks for the invite.
Yeah, hey Ron, thanks for taking the time. And we've been following your work for a while now. You've been covering oil and gas, obviously a lot of what's going on. Give our listeners just a quick gestalt of what's happening in the energy business with big oil, the Hess merger. How do you see things overall, and what are some of the big stories you're covering?
Wow. Okay, yeah. Well, look, I've been covering oil sector as a reporter and a columnist for over 12 years now, and it's been certainly a wild ride. If you look at everything that's happened since kind of 2013. And recent years, yeah, it's been a non-stop really for the energy sector. We saw the energy transition, and now the energy shock that followed Russia's invasion of Ukraine, and which left us in a very, very different place today. And there are so many strands kind of tying in to what we see in the energy space, oil, gas, but also the renewables and power. That well, yeah, we can take it in many directions. So I don't know. Where would you like to start?
So, Ron, one of the big things that has been a trend in the industry, especially at Exxon and obviously at Chevron, has been the push towards low carbon, right? And low carbon was a much bigger investment. I would say it's still a big investment, but much bigger pre the last election. Do you still see these companies investing heavily in low carbon? Obviously not extremely profitable for them yet, but do you see that as a viable business for them in the future?
I think for Exxon and Chevron in particular, they've kind of defined their own path in low carbon, which to me actually makes sense. So what they're saying is, you know, we don't think we have the particular advantage in renewables, but we do know how to run oil and gas operations well, and things that derive from that. And what we can do is focus on low carbon or lowering the carbon footprint of oil and gas operations, whether it's CCS or biofuels and biodiesel and stuff like that. And on the margin, also a bit of power markets, particularly in the US, given the hype around AI. I think that's also something that we're starting to see emerge more uh, with the two US majors for sure.
Yeah, for sure. We're seeing in the Exxon investor deck that they just put out not too long ago, the way they see low carbon is obviously low carbon hydrogen. You mentioned CCS, so their carbon capture business, which I think a lot of that was tied into the Denbury acquisition. You've got lithium as one of their other longer term businesses, and then carbon materials. What do you think? Obviously, they put biofuels in there too, but what do you think the most viable thing is? Is it going down more of this lithium route? Do you see it as the carbon capture business? Where do you see all this fitting in?
Well, look, I have to put a caveat. Having done this long enough, I remember Exxon and current CEO um, kind of bigging up algae and the idea that algae would play a huge role in the energy transition as a low carbon fuel. And of course, that project was largely written down. Uh, and it's kind of normal for these companies to try to hype up low carbon businesses. We have to remember that the vast majority of their operations are and will remain oil and gas. Within the space of low carbon, I think for sure uh, carbon capture seems to be a more viable kind of strategy to pursue for these companies. Also, because the technology is it works, it's operational, it's not something in the future, and we can already kind of see a path towards scaling it up, even in the US with everything that's going on and the kind of changes around the kind of climate targets under the Trump administration, but more broadly around the world, it's pretty obvious that for hard to abate sectors that will require oil and gas to operate, carbon capture will be a key technology to reduce carbon emissions and keep within government and corporate targets to meet climate ambitions.
So, Ron, you wrote an article August 5th this year. You said record production at Exxon and Chevron humbles European rivals. And we've seen that too. Shell and BP have just really struggled to keep up. What's your take on what's going on in the EU? Do you think they make a pivot and realize that they can't keep going down this road? Or do you think they continue to double down on some of what they've said? Where do you see things going in the EU specifically?
So if you're talking EU kind of government wise, so it'll be EU and the UK, they're kind of the same basket at the moment, for sure. I sense that there has been a very rude awakening since the 22 energy crisis that was spurred by inflation first, the post-COVID inflation, and more so after Russia's invasion of Ukraine that led to this huge crisis in your global, but European power prices in particular. That really changed the mindset among governments and corporates about the energy transition and the role of fossil fuel in the energy transition. It sharpened a lot of minds and focus on the fact that it won't be a rapid transition away from fossil fuel, and that will, under any scenario of transition, we will require a lot of fossil fuel for decades. So that really led to a change that translates into governments being a bit more open to extending the life of oil exploration and production in areas like the North Sea. But also accepting, coal and gas-fired power plants for longer than they had initially anticipated, and that's kind of filtering through to many parts of the business and then the energy complex.
Yeah, absolutely. And we just saw from CNBC on the 29th of July, Trump's EU trade deal is based on huge energy purchases. The EU has agreed to purchase 750 billion of US energy. Where do you see that fitting in? Is that meaningful in the context of EU's energy needs, or does that change? Does it change anything, or is it really not that material?
I think it is material, but it was material before with this announcement, if that makes sense. What happened was after Russia, after the Russian invasion of Ukraine and the crisis that ensued, Europe more or less immediately cut off most of its gas supplies from Russia, which were abundant and as a result cheap, and had to turn to the import of liquefied natural gas, LNG. And at the same time, US LNG production and exports started rising very significantly since kind of the back end of last decade. So that was kind of fortuitous for Europe. And since 2022, the region has been importing huge volumes of LNG, and a large chunk of them, over 50%, comes from the US. And that's kind of a symbiotic relationship that will only increase going forward, because Europe will require more LNG because it plans to cut the remaining gas it imports from Russia. Its domestic gas production will decrease, so as a result, it will require more imports. And the US will be there to supply those LNG cargoes. Now, as for the trade deal, the 250 billion per year over 3 years figure, that is a bit lavish. It's very hard to imagine how Europe could do that. The simple fact is that Europe's total energy imports from the US reached around 50 billion last year. And rising to 250 would be almost impossible, not only because Europe doesn't have that kind of demand, but also I'm not sure if the US has that kind of supply, given its other commitments, but also just not really realistic when you look at the scale and price of LNG at the moment.
So is that deal basically a classic, hey, let's just make a big splash with a headline like that, 750 billion. Is that the idea? And then, do you think they know that that's not possible, or is there really a path towards that somehow?
I think they know it's not really possible, and that's why in the wording, I don't remember the exact wording, but it's along the lines, or we will strive, or we will attempt to increase to 250. By the way, I think I said 50 billion. The European purchases from the US is 75 billion. So I'll stand corrected. But still, we're talking vast difference between that and 250. It's not I mean, the EU is not the only case. We see that with almost every trade deal that the US has been signing. Enormous promises or ambitions to increase imports from the U.S., whether it's South Korea, India, and other countries. They're all talking it up, but in reality, it can't happen. And anyone who looks at the numbers would realize that, I think.
Yeah, and if we look, Ron, talking about trade deals, tariffs, and the whole gamut and what's been going on here, let's let's talk India and China really quick and just how the relationship with the US and the EU and some of the sanctions that we've placed there to stop the buying of Russian oil in the process has kind of affected global supply and the price of oil in general.
Yeah, it's a very interesting development under Donald Trump's administration, the second one, and it's tied into trade talks, and it's tied into the efforts to put pressure on Moscow to end the war in Ukraine, and I must say that it's a very novel approach. And what the Trump administration is threatening to do, we should say, is I'll take a step back. The US has been imposing hundreds and hundreds of sanctions on Russian, Iranian, Venezuelan, Sudanese entities in an attempt to limit their oil, in particular oil exports. For years now. And now Trump has threatened to impose secondary tariffs on countries that are buying that oil. That's a very, very material change. So what happened after the invasion of Ukraine? Europe stopped buying a lot of oil from Russia, and that oil, rather than just stop producing it, that was kind of the intention of the sanctions. It started flowing to mostly to India and China and a bit into Turkey. Those have been the three big importers of Russian oil since then. And in particular, India, they've been buying the Russian oil, which has been cheaper, refining it, and then exporting the refined products, particularly diesel, back to Europe and making fortune on the way. And the EU and now Trump are trying to close that loophole. The EU imposed sanctions on that kind of trade, and Trump is now threatening to impose secondary tariffs on India for purchasing Russian oil. And that means that because it buys oil from Russia, the US will impose an extra 25% tariff on its imports from India, on top of the existing 20 or the threatened 25% tariff. So it's a very, very substantial hit to the Indian economy. That's the threat. Next week is when those secondary tariffs are expected to. So next week, I'm saying 27th of August, and we'll see. I suspect they won't kick in, but that's just my my gut feeling. And when you look at China, interestingly enough, Trump has not threatened that. In fact, he kind of said, for now, we're not doing that with China. And I suspect the reason is that China has kind of, had played chicken with Trump in the past, and he seemed to have blinked first when it comes with critical minerals and all sorts of other export restrictions that China had placed that really hurt the U.S. economy, leading Trump to back down. So he hasn't used the secondary tariffs on China as of yet. That, of course, could change.
Ron, you're obviously boots on the ground and in the UK. What are the differences that you're seeing with energy demand or energy policy? What are the differences between the UK and just the EU in general?
Yeah, it's an interesting one there. I think the UK is finding itself in a particularly uncomfortable position, simply because power prices here are significantly higher than in competing economies in the EU, France and Germany in particular, and that puts UK manufacturing and industry at a disadvantage. Particularly the energy intensive industries. That goes without saying. And the UK is also on this very ambitious path to grow its offshore wind industry significantly by the end of the decade. Britain has been a trailblazer in building up offshore wind and setting kind of financial fiscal terms to help companies invest in the sector, and it's been very successful up till now. But the economics really changed once inflation hit and interest rates started rising around the world, not only in the UK. That really changed the economics, making it much more expensive for producers to invest, and that kind of changed the whole balance. So now I think the UK is trying to rebalance the incentives for investing in offshore wind, and that just means higher costs in the near term. Obviously, in the long term, talking 10 years, the big investments in low carbon should lead to lower power prices, but that's a very long way. And you have the same parallels in Europe, the EU, Germany, France, Netherlands, Denmark are all investing in low carbon renewable energy, facing their own problems. I think the key is trying to remove subsidies from these technologies and allowing them to develop without subsidies. That would really help the sector develop and reduce costs for consumers ultimately, which is the ultimate goal.
Yeah, Ron, you're exactly right. I mean, we just pulled up the average gas price here in the US as of today was $3.14 in the US across the country. In Germany, it's $7.60.
Yeah.
So
And
what explains that? Is it the cost of regulation?
well, what explains it is that the United States has been blessed with a lot of natural resources. It's incredible to be honest. When you think about it, 20 years ago, the United States was investing in gas import infrastructure. And there was a lot of concern that gas prices, natural gas prices, and power prices in the U.S. would surge because of the shortage in supplies, and suddenly that kind of flipped the second the shale industry developed, and today the U.S. is the biggest producer of oil and gas, whereas Germany has really been kind of almost the mirror image with very little domestic production, and with the cutoff of Russian gas supplies, it really felt the pinch and is now dependent on a lot of LNG imports and is also investing heavily in renewables to try to change that, but it will take time.
Yeah,
And
absolutely. Yeah, go ahead, Sam.
yeah, and I was just going to say too, along the kind of the same vein, you wrote an article at the beginning of the month just talking about the AI hopes over for you guys. Energy's already more expensive. Then you have these very, power heavy needs with the AI revolution, investing in the country, kind of trying to grow that. Is that going to be something that drives prices higher for you guys as well, or? Is that something that's a concern as far as development goes with kind of within the country as well?
Yeah, I mean, it's all about competitiveness, there's no question. And the UK has set its sights on increasing um, the role of AI in the economy, data centers, which makes a lot of sense. But that requires a lot of energy, and it requires a lot of cheap energy. So reaching that kind of holy trinity is going to be very difficult. Um, you know, it's hard to forecast these things because I mean, even if you look at the U.S. When you have companies like Meta and Google and Amazon investing in enormous energy projects, we have
Hmm.
to remember that for them, the actual cost of energy is a secondary cost. They're not investing in nuclear plants or renewables and solar or gas-fired plants to make money from that. The money engine is the data center and AI. Um, so you could have the same thing here in the UK, where companies will have an incentive to invest in AI, and as a result, they will invest in energy. But there's no question that when you have such a huge disparity between US and European energy power prices, that can create kind of a very uneven playground for AI and tech companies. So yeah, it's a problem.
Ron, let's talk a little bit about the majors here. So you had some stories come out about a potential Exxon Chevron merger. A lot of people say that the Justice Department would never allow that, but you look at Microsoft here at a $4 trillion market cap. You look at Nvidia over 4 trillion, and these are massive monopolies. Same thing with Google and Amazon. Why couldn't we have an Exxon Chevron merger? It'd be a $800 billion combined company. It's still a fraction of a Microsoft. Why couldn't we have that?
Yeah, I wrote that column right after the arbitration between Exxon and Hess and Chevron over Guyana was was completed in favor of Hess and Chevron. And I looked at Exxon and Chevron, and really what strikes me is a lot of parallels in their portfolio, particularly in the upstream. When you look at how important the U.S. shale patch, particularly the Permian, is for both companies. They're the biggest players in the Permian without a doubt. And add on top of that Guyana, the Gulf of Mexico, Kazakhstan, and many other kind of geographies. Um, and you kind of ask, well, it's there's a lot of overlap, and from a purely kind of financial synergy perspective that a lot of bankers and analysts would look at, you'd say, well, it makes sense perhaps to merge the two. Of course, this is I don't think it's anything on the cards yet, but I do believe that in a scenario where oil prices are low and competition between the U.S. and OPEC and other major producers, Brazil, grows, it will all be about the margin, and a very effective way often to cut your margin is by merging, bringing synergies, taking out costs, all those good things that we know all the time when we hear. So eventually, I definitely see that happening. It might take a decade, but I honestly think that as the energy transition progresses, we could see that scenario. And we already saw a big wave of consolidation among U.S. producers over the past, what is it now, 2, 3 years? Major wave. And this would be a continuation. Of course, Exxon and Chevron push back on that, but I, I still see the logic there.
Well, it'd be like a fight against a common enemy in a way, which is, I guess, anybody who's not the U.S.,
So
but mainly China.
we're gonna call it
Yeah.
checks on, right?
Well, I had a few other names suggested to me from from all sorts of contacts and readers, but I don't know why I went with Checkson, although it doesn't yeah.
So off of that note, then how important was it for Chevron to win that lawsuit and acquire Hess? To me, it seems really important that they won that from their standpoint. But what's your take on that?
Yeah, hugely important. Hugely important for Chevron, hugely important for the CEO, Mike Wirth. It was a painful episode. And, you know, as a spectator, it was quite something. We've always known about this competition and, professional animosity between Chevron and Exxon over the decades. We've seen it time and again. But this felt like it got really personal when Exxon decided to pull the trigger on this arbitration and really put, in doubt a major deal for Chevron. So having had to delay the completion of the Hess deal and go through all the tribulations of the arbitration, um, and in the end, having won it means a lot for Chevron. From a reputational perspective, I think Mike Wirth would have been in a very fragile position if it didn't go their way. I don't think he would have survived, but that's all history now. So, from Chevron's perspective, operationally, it gives them huge kind of growth trajectory for this decade, gives them a big foothold in a major new basin in Guyana, and I'm sure there'll be much more coming from there over the next years. It can be oil, it'll also be gas and LNG potentially. So there's a lot going on there, and even they also increased their position in the U.S. shale. So it's really significant. And funnily enough, I think it's a major deal, but it doesn't solve Chevron's problems beyond 2030, and I think that's something they will have to deal with in the coming years. But for now, they must be very happy that they have Hess behind them and kind of a lot to work on in the coming years.
What happens here with BP? Does BP eventually just fold into Shell? I know Shell's come out and said they think there's better uses of capital, like paying higher dividends, buying their stock back. Do you see that as the more likely route, or do you eventually see it where BP just folds into Shell?
Well, a bit like Chevron and Exxon, I don't see in the long term much industrial logic in having two big UK oil majors. So in the long term, I definitely see something happening with BP, BP Shell, BP Chevron. I don't know. I mean, but specifically at this point in time, I wasn't a huge believer in Shell acquiring BP. Shell had looked at BP several times over the past 12, 15 years since the 2010 Macondo disaster, and it never really worked for them. It's on paper, it makes a lot of sense for maybe even for analysts, but when you speak to the companies, you realize that integrating two huge companies into one is an extremely painful, expensive, risky business that will probably face enormous regulatory hurdles, approvals around the world, And ultimately, there are some businesses that just don't sit well together, which would result in, the buyer having to divest a lot of the businesses that it acquires from BP in this example. So I think that in the long term, there is logic and someone acquiring BP. But at the moment, I think it's quite a tall order for any company.
Yeah, absolutely. Okay, so let's talk a little bit more about the U.S. fracking revolution, what's happened. Obviously, it started under the Obama administration, and the Obama's EPA came out and basically studied fracking. They said, go ahead, right? Like they gave the green light to what we're seeing with the shale revolution. We see some pretty big boom and bust cycles there when Exxon came out and bought XTO years ago. Obviously paid pretty hefty price for it, and we're starting to see some of the animal spirits return to the fracking world. Do you see us at a peak in the cycle? Do you see us still having some room to run with the new EU deal, the India deal, or are we really starting to top out on where oil is going to be for the foreseeable future?
Yeah, I mean it's absolutely amazing technology, fracking, and unlike maybe the kind of the offshore revolution, which required enormous kind of industrial projects and big project engineering skills, fracking and the shale revolution were all like essentially experimenting with small wells, small drilling techniques, and until reaching something that's been, absolutely revolutionary. And the EIA expects production to continue growing to around 40 million BPD this year, I think, and a bit more next year before plateauing in 2026, 2027. And other companies have also kind of made similar prediction. The truth is, given history, I don't want to make such a bet. I just kind of feel that it's dangerous betting against the U.S. shale patch. Every time that they thought this is it won't get any cheaper, it won't get any bigger, some technology came in and really revolutionized it. And it's true that the kind of tier 1 and 2 layers of the big basins, particularly Permian, have been explored and depleted significantly. But there are other tiers lower and in other acreage that is perhaps less good. But I wouldn't be surprised if within a few years new technologies would make those frontiers really economic. Maybe not for oil, but for gas for sure, which is a huge growth market for the United States.
For sure. So, Ron, and I know you can't talk investments specifically, you can't talk stocks exactly, but from our perspective, one of the things that's emerged has also just been how these oil companies have taken care of investors and their return on capital and what they've done with their cash flows. Their return on equities have been a huge focus on Wall Street, and from our perspective, Exxon has just led the pack with returning capital to shareholders, which is why their stock has basically performed better than any of these other companies, been basically the best house in a bad neighborhood. It's not to say these other places don't have great technology, great innovation, great people working there, but Exxon just uniquely has delivered return to shareholders in a different way. What's your take on that? Do you think these other companies, I know you've written some articles on how these other oil companies have tried to replicate Exxon doing that and they just haven't been able to. So what's your take there? Can they start to reshift their balance sheets, their income statements to favor investors a little bit better?
Yeah. So look, I mean, Exxon went through a terrible period, kind of under Rex Tillerson, and you mentioned XTO. And even under that, it was really the company was in a very poor position. But then kind of restructuring Guyana and Permian and investing counter-cyclically really got Exxon firing at full power just when the energy prices started rising, and it just it's just been reaping huge dividends from that counter-cyclical investment. And to a certain degree, Chevron also benefited from that kind of mindset, also because it owned a lot of very high quality Permian assets for a long time. And generating so much cash allowed them to return a lot to investors. It also allowed them to reinvest in the business. So it's one of those very positive cycles. On the other hand, the Europeans, they chose a different path, trying to invest in the energy transition, particularly Shell and BP. So they tried to build significant low carbon businesses since kind of late last decade. That didn't work at all well, and they've more largely pulled out of that. And now, for the last kind of year and a half, 2 years, they've been trying to reinvest in oil and gas, which has been kind of a big generator of revenue as historically. And so they're just behind the curve when it comes to competition with the U.S. and with the U.S. companies. So how long it will take them until they really, for Shell and BP, they'll start reaping the benefits from this investment is a question. But for sure, the point is that Exxon and Chevron have a huge lead already, and they're kind of investing more and more. So it'll be very hard for the Europeans to catch up with the Americans in terms of scale and returns, particularly if we have a downturn in oil prices. That's a big problem. Shell, I think they have, on the wells, they've cut a lot of costs and focused hugely on taking costs out of the system by divesting. But as a result, they're not reinvesting a lot, and that's a problem going forward. BP, it's been a mess for operational reasons, leadership reasons, and well, hopefully for them now they're starting to kind of return to positive to a positive trajectory, but it still will take them a long time to recover.
Ron, you talk to analysts, and I'm sure you get a sense for what is it that Wall Street is really looking for from these energy companies? Do they want to continue to see this push towards low carbon? Because that certainly doesn't seem like it's been rewarded in the marketplace. Or is it like, hey, pay out all your earnings, give us buybacks, give us more dividends, give us higher ROEs? Is that really what shareholders are looking for going forward?
Yeah, the latter. I think the oil and gas industry has been for a long time a very bad manager of money for investors, and returns for a couple of decades were quite poor, and they were certainly unstable. You had a lot of fluctuations in returns, and following COVID, there's been a big change in the mindset of both investors and boards. And now investors really want to, I call it to squeeze every penny they can for these companies. To me, it feels a bit like managed decline in the way that, investors don't want these companies to go on huge acquisitions for future businesses. They're happy with acquisitions that yield cash flow very quickly, if not immediately. Things that they can support dividends and support supporting the capex. But other than that, I think that they're not very keen on energy transition and big long-term strategies. They're very much focused, investors are and boards, on making sure they can generate dividends, buybacks, and returns to shareholders.
Yeah, that's great. And Ron, to kind of close things out here, last question. You just recently, I think this was Wednesday, you posted this, the oil price smile could leave traders in tears. We've seen production increase. I think it was 2.5 million barrels a day this year. We're going to see 1.9 million barrels per day increase next year, but consumption is expected to be far below that. And in a time where you'd expect there to be less drilling and getting out of the ground and more holding it in reserves, that's not necessarily what we're seeing. Could you just build on that a little bit as what's going on broadly across the globe? You'd mentioned the US and OPEC kind of fighting there and how those dynamics play into it as well.
Yeah, look, it's an interesting one. It's a really, really interesting. Think about we're already trading the October contract for Brent, so well into we're in Q4 when supply is supposed to outpace demand by a very significant margin, according to forecasts from the IEA, the EIA, and then other banks. So you would expect prices to be lower, but definitely you would expect kind of the forward curve to reflect these weak fundamentals and allowing for contango for storage economics to kick in, and we're not seeing that. It's a real mess, I would say, and it's hard to explain exactly why it is. Maybe it's because investors just don't believe these forecasts, because demand has been surprising on the upside for most of this year. There was a lot of expectation for a slowdown with the tariff and trade wars, but that never happened, and demand is still strong. But the fact is that we're expected to see a huge increase in supply from OPEC and other producers, and demand just won't meet up, and the prices and the forward curve just doesn't reflect this dynamic, which is a conundrum. And I expect things to correct eventually and very quickly in the coming weeks, if indeed we'll start seeing that kind of build in inventories.
All right, thank you. Well, hopefully we don't get any tears, but really appreciate you joining, Ron, and for all your insights. Thank you, everyone, for listening to another episode of Bullish. Again, make sure you like, subscribe, share that show so we can get the clarity, the confidence, more wonderful guests like Ron joining us, and we'll see you soon. Thanks so much for joining.